Hello, my name is John Reade and I'm Head of Research and Chief Market Strategist at the World Gold Council, based in London. This video makes the investment case for gold and is designed as an accompaniment to a report titled The Relevance of Gold as a Strategic Asset, which we wrote earlier this year. This report and the presentation that accompanies it is our attempt to explain why gold should always be part of your investment portfolio. Although we discuss gold's performance in US dollar terms and compared to a US asset portfolio, similar arguments can be made when looking at gold in different countries and portfolios based in other currencies. Before I start, I'd like to introduce you to the World Gold Council.
The World Gold Council is a market development organisation owned by its members, 26 leading gold mining companies globally, and we are tasked with making gold a mainstream investment asset class. We demonstrate this authority on gold through providing data and tools to analyse the gold market and by producing research and insights into gold. We conduct work with policymakers and central banks around the world and attempt to improve the market infrastructure such that consumers and investors can buy and sell gold as easily as possible. Moving on to the investment case for gold, this focuses on 6 crucial characteristics of gold. Firstly, as a source of returns. Gold has been a source of long-term returns to investors since 1971. It's not just an asset that has performed well during times of crisis, nor just an asset that's performed well in periods of high inflation. The numbers speak for themselves. Since the gold price was released from its peg against the US dollar in 1971, it's produced returns that are comparable to other financial assets. Over that period, the average return at 7.8% is higher than those of bonds, cash, or emerging market stocks, and only slightly below those of commodities, US equities, and international equities. Gold's returns were not just due to a one-off revaluation effect. Its returns over the 20 years to December 2018 were 7.9%, better than any other asset class, except for developed world equities, excluding the United States. Even over the past 10 years, gold's average returns have been a reasonable 4%, better than US cash, US bonds, and negatively returning commodities, but below equities in all 3 jurisdictions. Over shorter rather than longer periods, economic cycles influence the returns of gold and other asset classes, and gold's underperformance of equities over the past decade has been largely due to the recovery seen in equities following the global financial crisis. Gold's relative underperformance over the past decade may also provide a good opportunity to adjust portfolio weightings. And that leads into gold's second crucial characteristic as a portfolio diversifier. It's been long recognised that gold is uncorrelated to other asset classes, but that lack of correlation is calculated as an average over a long period of time. Here we've examined how that correlation changes depending on the performance of the US equity market. Since 1987, during periods of neutral performance, in other words, when weekly returns of the S&P 500 are within 2 standard deviations, either up or down, gold is very slightly negatively correlated, essentially uncorrelated, to the US equity index. When the S&P 500 performs strongly, when it's up by 2 or more standard deviations in a week, gold is positively correlated with the S&P 500. But when the S&P 500 falls sharply by 2 or more standard deviations, then gold's correlation flips over, and gold is then negatively correlated to US stocks. This characteristic is extremely useful for portfolio diversification. Gold tends to perform well when US equities are moving sharply higher, and the switch over to a negative correlation when equities do particularly poorly really helps overall risk-adjusted portfolio returns. Gold is the only major asset class that exhibits this switchover. As an example of this, we've also shown the performance of a commodity index during the different regimes over the same period, and no such switchover is seen. The first 2 characteristics, returns and effective diversification, combine to make a positive impact on portfolios. Including gold into a portfolio has generally improved the risk-adjusted returns, even over the past 10 years when its absolute performance was only about 4% per annum. This first graphic here shows the hypothetical asset allocation of a typical US pension fund at the end of 2018, based on data from Willis Towers Watson. The graphic on the right shows the same portfolio with 4.2% allocated to gold. Analysing the performance of this optimised gold-containing portfolio over the past 10 years shows that returns increased a little, but volatility and maximum drawdown declined a lot. So focusing on the metric of risk-adjusted portfolio returns, adding gold improved the risk-adjusted returns of that typical US fund portfolio, irrespective of whether the allocation to gold was 2%, 5%, or 10%. Within that 2 to 10% range, the higher the allocation to gold, the better the improvement in the risk-adjusted return. The next characteristic that is important to consider is the volatility of gold. Despite its reputation as a risky asset, gold volatility over the past 10 years has been comparatively low. Since 2009, the annualized daily volatility of gold has been in line with the S&P 500 and with international equities. It was less volatile than commodity indices or emerging market equities, and much less so than the most volatile S&P 500 stocks. Also, gold is a deep and liquid market, with about $100 billion trading each day around the world. This is more than in German bunds, more than in UK gilts, it's more than the member equities of the Dow Jones All Stock Index, and more than the Euro-Yen exchange rate. S&P 500 stocks, US agencies, JGBs, and the sterling dollar exchange rate are more liquid than gold, as is the US Treasuries market, the most liquid of the instruments considered. Finally, we would like to show that gold performs well during periods of high inflation. Since 1970, during periods of high annual US consumer price inflation, which we've defined as greater than 3%, gold posted a 15% nominal return and an 8% real return. But during periods of low inflation, defined as annual CPI below 3%, gold still posted positive real and nominal returns, 3% and 5% respectively. This is a reminder that while gold does perform well during high inflation periods, it's also given a return in low inflation periods too. I hope I've explained that gold is not just a safe haven or just an asset that performs well when inflation is high. It's an asset that is a source of returns and an asset that is particularly effective as a portfolio diversifier, especially during periods of sharp declines in US equities. Together, these characteristics boost risk-adjusted portfolio returns, yet the deep and liquid gold market is not particularly volatile. We believe gold should be a strategic component of most, if not all, investment portfolios. Thank you very much for your attention. The report that I mentioned in the introduction, The Relevance of Gold as a Strategic Asset, is available on our website, www.gold.org, in the research section of Gold Hub. It, along with all our research and strategy, is freely available to download,